Hello, I'm Alan Austin from Calibre, and I'm here today talking with Mark Wooster. Mark's Chief Investment Officer of the Calibre investment team, and he and his colleagues are responsible for managing the portfolios that you're invested in. I'm talking today with Mark about term deposits and why they can actually be quite dangerous for your financial health. That sounds quite scary actually, because you wouldn't think that something that's generally regarded as being pretty conservative and safe could be like that. So investment markets have been bouncing around quite a lot of late, and term deposits have actually risen from about 0.8% to around about 5% over the last 2 years. That seems like a fairly attractive, safe and conservative option. What we're seeing then is investors coming out of long-term growth portfolios into TDs, or term deposits as they're known, and then looking to time the market and go back into their long-term growth portfolios when markets have calmed down a bit. Does that seem like a sensible strategy? Well, 5% is a reasonably good return, and surely TDs are a safe and conservative approach. But appearances can actually be quite deceiving, and term deposits are actually one of the riskiest asset classes that you can actually hold. To quote Warren Buffett, one of the great investment gurus, term deposits are in fact a really dangerous asset class to hold, because over time they don't keep pace with value. So I'm going to talk with Mark today about why in fact getting out of your long-term growth portfolio into TDs and then trying to time markets and go back again into your growth portfolio is actually a seriously risky strategy, and in fact almost a knee-jerk reaction. So Mark, let's talk about this notion of trying to time exit from a long-term growth portfolio into TDs and back again is basically a pretty poor strategy and really almost just a knee-jerk reaction.
Yeah, I mean, it's understandable people wanting to jump out. Term deposit rates look pretty attractive at the moment. You know, if their equity portfolios have had a bit of a flat period. What we've got to remember, of course, is 2022 was a pretty bad year in terms of performance. The big thing, I think, just to add too, is not poor performance in 2022, not just from a perspective of equities, but it was one of the worst periods for bonds in about 35 years. So that combined produced quite a bit of volatility, which then spooked those longer term investors. The fast moving environment with central banks trying to combat inflation and interest rates going up fast, going from 0.8 to 5% happened pretty quickly. And so you can understand why people think that's attractive. Why would I be bothered with all of this volatility and uncertainty when I can get 5% over here? The trouble is you've got a complete mismatch of your liabilities, if you like. If you're a long-term investor, have an investment horizon of 25, 35, 40 years even, you've got all of those lifestyle expenditures, holidays, looking after the family, replacement of cars and whiteware and so on. They stretch out over that investment horizon, and so that's almost like a liability curve. So what you're doing though is then matching up cash and term deposits, which by its nature and definition is a very short-term investment, and so you've got the mismatch there, but then trying to time your way back into markets is notoriously difficult. Nobody knows what's going to happen. You can get what people call a dead cat bounce, which is a recovery, and then it falls again on the way to a further drop. So people are always aware of that, and they're always cautious about jumping back into the market. Invariably, people come back into the market halfway or 2/3 of the way up the rally. And what we do know too is if people miss a few of those key days, they actually miss out on substantial gains in the market. So it really is, as the old adage says, time in the markets for equities. We need those equities to beat inflation, and as Warren Buffett said, and I've heard it, it's been known for a very long time, that cash is the riskiest asset over a long period of time, because it's the asset that gives you the least opportunity to beat inflation. Equities give you the best opportunity, but they're volatile, and that's what spooks people. So as you say, we understand why they seem attractive at the moment, but unfortunately, as you defined it, it's a good way of explaining it. It is a bit of a knee-jerk reaction, whereas and it's not really a strategy if you're a long-term investor, and that's why it's quite a dangerous asset to be in if you're a long-term investor, and that's why even with such attractive rates, they can be a bit harmful to your financial health just because of those issues.
Okay, that's really great. Can we talk a little bit more then about some of the key risks that are inherent in this? And as I think we've already mentioned, there are some significant risks about this, but a lot of people just aren't aware of those. And again, to quote Buffett, he defines risk as not actually knowing what you're doing. So if you are better informed as an investor, then clearly you can take a much better approach to managing risk.
Yeah. So the biggest risk that most long-term investors face is that silent thief, inflation. We know that over a 20-year period, even at just 2%, you lose 50% of your purchasing power. So it's a significant risk. Of course, inflation's much higher at the moment, but that's the main risk and challenge that long-term investors have. There are other issues as well. So as we said, that's why you need assets that can help you combat inflation. And so we also know that the higher the risk, the higher return. When we talk about risk, we diversify portfolios so much that we're not really talking about default risk or a single investment falling over and impacting a big part of your portfolio. We focus on very broad diversification, so that when we talk about risk, it's really how much the portfolios jump up and down. But as we've seen with people lately, that's quite a significant risk for them, because it introduces in their minds uncertainty as to whether they are in the right place. Is this right for me? Is it going to work out? And unfortunately, they crystallise some of that by jumping out. They actually crystallise unrecoverable losses, and so that's really unfortunate. But it's totally understandable, because that's where you need a strategy of matching and aligning the portfolios effectively to ensure that, yes, you get enough of the growth assets that you need to combat inflation, but they're not going to be so volatile that they're going to blow you out of the water and not enable you to sleep at night and keep you guessing as to whether you're in the right place.
So Mark, the key question here is, do term deposits actually outperform inflation? So we're now going to delve into this a little bit deeper and throw a chart up on the screen and talk to that.
Yep.
This chart actually shows New Zealand inflation measured by the Consumer Price Index, or CPI, and it's actually for quite a long period of time, from 1965 right through to the end of 2022. So it's 57 years of inflation.
So the answer really is it depends. Very definitive answer, obviously. But it would, like a lot of investment outcomes. A lot of people don't realise how period specific returns and asset returns are. So we sort of get caught up in the middle of them. But what occurs is you get very strong environmental factors coming into play. So, for example, you can see in the chart that from post GFC through to more recently, we had very low inflation, we had very low interest rates, and that actually drove a very specific sort of investment outcome. What we've been talking about is a really sharp shift to we don't know whether we're moving into another structural move to another period, or this is a blip in the current one. But what we are talking about is some significant changes, as you can see in the graph, from the previous period. So it does depend a bit on the period that you're in. But the key point is, nobody can really pick what's going to happen next. It's really easy for us to look back, especially at a graph like this, and see very defined periods where you might say, oh, well, clearly you'd take that action. But when you're in the middle of it, you can't see what's going to happen next, and it's not clear as to what the next step should be, what you should be invested in, and so on.
So Mark, a couple of observations about this chart then. It seems like it's almost divided in two, from the 1960s through to about sort of the late 1980s. What actually went on in that first period of time, and why was this massive drop in inflation happening around about the end of the 80s?
Yeah, well, the 80s were very high commodity prices. You might remember very high oil prices and so on. And so a lot of those sorts of shocks drove supply chain issues, a little bit like we've seen recently. And so you had what was really what people called hyperinflation, very high levels of inflation. But what you did see is quite a different period there in terms of central bank response. And so there's the famous case of the US Federal Reserve, their central bank, their reserve bank, really had a couple of runs at trying to contain inflation, but because they really didn't nail it, inflation got worse. And so there's the famous case of Paul Volcker, US Federal Chair. He came in and made a commitment to actually cutting that inflation down, reducing inflation, because it has such a detrimental effect on the real economy. And so he had to hurt the economy quite badly, actually, and threw the US and then the rest of the world into recession. What he did was he really tightened up interest rates and tightened up monetary conditions, and very similar to what we're seeing now. But he kept on it and really nobbled on inflation. And as you can see from that graph, we've actually benefited from that. We've had that low inflation dividend, if you like. The global economy has been able to operate in a period of low inflation, much more certainty about where it was and so on, and not having to deal with the detrimental effects of that higher or hyperinflation. And of course, in the late 80s, early 90s, what we saw was actually a period where central banks became more independent. We had the 1989 Reserve Bank Act here, which actually gave the Reserve Bank here a level of independence, specific targets, and so we actually became a model. Don Brash used to go and talk to the US Federal Reserve when he was travelling overseas. And so that's what happened in the late 80s and early 90s. And then you had all sorts of interesting effects, like, in the early 90s, Margaret Thatcher supported that as well, that fight against inflation. But a lot of people were a bit slow in reacting. And in the early 90s, we saw more than 1 million households in the UK where the mortgage ended up being more than the house was, because you didn't have that constant upgrading in terms of inflation.
I think it's also interesting to look at this chart and see that there's actually quite a lot of bouncing around of volatility in terms of inflation rates.
Yep.
And that suggests, I think, that using interest rates to control inflation is a pretty blunt instrument for reserve banks, and that's why we're currently seeing so many issues around what's happening here in New Zealand in terms of interest rates being pushed up so dramatically to try and control inflation. Interestingly enough, the average over that entire 57-year period is around about 5.7%, 5.71%. So bear that in mind, because we're now going to look at the next chart, which is chart number 2. And what that actually shows is the New Zealand inflation rate over that same period of time, but compared with the 6-month term deposit rate. And the term deposit rate's in green, and that's been taxed at 30% because, as you know, when you invest in term deposits, tax is deducted at source by the banks. So that's a net term deposit rate in green and the New Zealand inflation rate in blue. Mark, what are some of the takeouts from this chart?
Well, I think it's what we were mentioning before, is that the problem is inflation isn't taxed, but the income is. And so when you have higher interest rates, so I remember, I've worked for 2 banks, and I remember one time in one bank we were cleaning out a storage room, and we pulled out a 22% term deposit rate. People thought they were doing fine, but as we'll see in a future graph, they were still underwater after tax and inflation. So that's the problem too, as you have higher interest rates to compensate for the banks, the central banks trying to push back on inflation. And that's reflected in the term deposit rates. Obviously the tax bill is higher because it's on the income. But I think the big takeout is that that the after tax and after inflation rate is lower, and that feeds into, you know, the statements by Buffett and a huge amount of other people, including Nobel Prize winners, about cash being the worst asset. They're not necessarily talking about tax in there, but that tax element feeds into that as well.
So the average 6-month term deposit rate over this entire time has been 4.75%. And just a moment ago we talked about the average inflation rate over that period of time being 5.71. So that actually suggests, in fact, that if you'd held a term deposit and over that length of time, then you probably would be underwater on that. What's really interesting too is if you look at the graph again, in the first part of it from the 60s through to the late 80s, you can see that inflation is much higher than term deposits, but then subsequently it looks like term deposits actually, certainly for a degree of time, outperform inflation. So let's actually just bear that in mind and look at the next chart, which is chart number 3, and that's actually the difference between inflation and the 6-month term deposit rate over that 57-year period. And what you've got here is the line in red, charts that difference. When the red line goes below zero, the zero axis, that means that you're losing money on a term deposit. When it goes above the zero axis, it means that you're gaining in terms of holding a term deposit. Mark, again, what can we learn from this chart?
Well, I think, yeah, what's really telling is the first part of that chart where, as I say, you know, pulling out interest rates were much, much higher, but look at that line, they're below, they're underwater, so they're actually getting negative outcomes or negative returns after tax, and so that's the most telling one. Then, you know, we get you know, Volcker's dividend for 30 years of his contribution to the real economy, where we get inflation under control, so we get a bit of real return, which is good. But what's not on this graph, of course, is what are equities and other growth assets doing.
Yes, exactly. I think what's also interesting too about this is that even though there are periods of time when the difference is positive for people who are holding TDs, there's a lot of volatility in the way that difference bounces around. And so, you know, that's really interesting because, as we mentioned, this is a 57-year time frame. I'm not sure that I know of anybody that's invested in TDs for 57 years, but what about shorter time frames? What happens if we take, say, 10, 20 and 30-year time frames for investing in CDs and look at the impact of inflation on that? So let's assume that we've got an investor who's got 100,000, they've invested that in a 6-month term deposit that rolls over, and they do that for 10, 20 and 30 years. And we're going to throw that chart up on the screen now, and that's chart number 4. And what's really interesting here is the fact that it's probably not what you'd think. So Mark's just going to comment about that. Mark, what do you?
So the big thing is that it's not just about the rate of interest that you're receiving. You know, so people might say, well, look, I'm okay. Inflation's 4%, I'm getting 6%, and maybe even after tax I'm slightly higher. But what a lot of people forget about is that inflation is already and always eroding the capital value, the capital base. The 100,000 you've got invested is also depreciating due to capital. So when you add that to the interest rate, you actually end up in a much worse position than you think you are. So, you know, I'm aware of a case in Australia where an executive retired quite a few years ago with $130,000, probably worth about $2 million now, invested for a very long period of time in term deposits, and still ended up with $130,000 years later. But of course, the purchasing power of that had eroded significantly, and he was actually keen to inform other people, tell other people, look, you need to have a different strategy, because, you know, he took advice from professionals and so on who thought they were trying to do the best thing for that family, but, you know, clearly that that purchasing power just got eroded completely, so they ended up with far fewer options, 10, 20, 30 years down the track than they could have. And they started with a pretty meaningful sum, and that really is the power of that compounding effect. We know and talk about the compounding effect of interest and so on, and investment returns. But what we forget is that big thief, that big silent thief, is also compounding, and that's what. So I think that's that those graphs illustrate that people would probably end up in a lot worse position than you would think they would, and that's because you add the impact of the capital base depreciating, as well as whatever real interest rate or otherwise that you're getting at that time.
I think this goes back to, as well, to as an investor, a long-term investor, you need to really be able to define your objectives. What is it that you're trying to achieve? What is it that you want to do? And then thinking about risk. How much risk do you need to take to fulfill those objectives, and versus how much risk can you actually feel comfortable with? And there's an obvious tension in there. So circling back then to what Warren Buffett said, if you don't understand what you're doing, then you are in fact incurring significant amounts of risk. So Mark, we've talked about inflation as being the biggest risk to TDs. What are some of the other risks that might occur if you're investing in TDs?
Yeah, I mean, you've got reinvestment risk, and you spoke about volatility, and we've been looking at quite long time frames, and sometimes they wash out. If we zeroed into shorter time frames, that point that you were making about volatility is a strong one, because we would see even more volatility, which gets washed out a little bit when you're looking at those graphs from a long-term perspective. So reinvestment risk is a big one, because you can go from one period to the next. So it's a little bit like mortgage rates. People are rolling off very low mortgage rates into much higher ones, and so that's quite a significant disruption and quite a significant impact and event, especially if you're talking about somebody's life savings. Clearly they will try and ladder the maturities, but even so you can move from one regime to the next quite quickly, and we're talking about going from 0.8% to 5%, but don't forget they came down from about 5-6% to 0.5 quite quickly as well. Yes,
and I think there's an example in the 1980s when 6 months term deposits went literally inside a year from 14, nearly 15% down to 5. Down to 9.
And that's a significant event and impact, and so again it goes to what sort of certainty do you have about achieving your objectives, and the problem you've got again is you've just got this mismatch against the asset and your liabilities. So you've got a term deposit by its nature is a very short-term investment strategy, but you've got these liabilities or this expenditure that you want to make just in the normal course of living that span years out along your investment horizon. So there's that complete mismatch then. So that's a big driver. That's a big part of what one of the biggest risks are with term deposits.
And they can go up, of course, but the chances of predicting when they're going to go up is equally poor as when they're going to come down.
Well, and as we saw in the early 60s, in the 60s and 70s, the early part of that graph, even when the interest rates go up, it doesn't mean you're necessarily better off either with term deposits. It could be a period of high inflation where you're actually underwater. So again, higher returns in that space don't necessarily equate to higher real returns.
And I think just circling back to what we talked about earlier in respect of timing markets, the same thing holds with growth assets. All right? If you're trying to time the market, it's highly, highly unlikely that you'll be able to do that with any degree of success. And there are in fact some interesting statistics around the number of days in the market and the returns. So perhaps you'd like to talk to our viewers about those.
Yeah, I mean, you can find them everywhere, but the nature of equity markets is that it's not just a slow, steady. You get periods where the market becomes aware of different type that the environment changes or news, or as we've seen in New Zealand with the drop in the inflation rate and so on. those aren't necessarily predictable, and they happen very fast, and you have to be in the market to capture that. If you miss out on a few key days in equity market returns, when the market is on the rise, your overall return or outcome from being involved in the market is much, much lower than if you're there for those days.
Okay, thanks for that, Mark. So what are the conclusions here about this?
Well, I think the big one is that it's understandable why people are looking at a lot more at term deposits, but the big issue is that it's not really an effective strategy for a long-term investor, and in fact it introduces some very real risks. And just going back to the previous point, there's a big research company in the US that shows what investors' returns are for being involved in markets and what the actual market return is. And they have periods like 37 years where the S&P 500 returns just about 12% per annum, whereas the average investor in the S&P 500 earns 4%. And that's because they keep trying to time it and jump in and out and missing those key days. And so they have a 7% per annum differential. I mean, that's huge. So that's the big issue, is that what people have got to focus on is trying to maximise the probability of them achieving their objectives, understanding their long-term investment horizon, and then getting in a proper alignment with their investment strategy. And that's the biggest problem with term deposits. While they're okay for the short term and they look very attractive, they're not an effective strategy for a long-term investor. And in fact, that's why we had that provocative headline is about, are they good for your financial health? Well, that's why we strongly believe that they do introduce some real problems and risks for long-term investors, and they are just not as effective as a more diversified portfolio, which actually creates, it's counterintuitive because you've got more volatile assets in there, but that actually creates a much more certainty for families investing their life savings. So for serious money, for big lumps of money, their life savings, it's important. It's very important to families that they address that effectively. The strategy of jumping out into term deposits, trying to time your way back into equity markets and so on, is just not an effective strategy. It introduces real risks of you not getting to where you are, and real risks of sort of hanging back and being in term deposits for very long periods of time, and your purchasing power down the track, which gives you the options, is seriously eroded.
Thanks, Mark. And thanks for watching. We hope you found that interesting and informative. If you have any questions, please feel free to contact us via the Calibre Investment website, or talk to your advisor and they'll be delighted to help you. We do have lots of other videos loaded up on the website. They've got some fantastic information on them, and we'd really encourage you to look at those. And we look forward to talking with you next time, which will be really soon.